Now speaking, Steve Tannell, Vice President, Investor Relations. Welcome to Elevance Health's second quarter 2023 earnings call. Gail Boudreau, President and CEO, John Gallina, CFO, Peter Haytayan, President of Carelon, Morgan Kendrick, President of Commercial and Specialty Health Benefits Division, and Felicia Norwood, President of Government Health Benefits Division are all present. Gail will begin the call with a brief discussion of the quarter and recent progress against strategic initiatives. John will then discuss financial results and outlook in greater detail. During the call, non-GAAP measures will be referenced and reconciliation of these measures to GAAP measures are available on the website. Forward-looking statements will also be made and listeners are cautioned that these statements are subject to certain risks and uncertainties. Elevance Health reported strong second quarter results, with revenue increasing by 8% year-over-year and net income increasing by 10%. The company also announced new initiatives and projects, including the launch of a new product line and expansion into new markets. These initiatives are expected to drive further growth in the coming quarters. Now speaking, Gail Boudreau, President and Chief Executive Officer. Good morning, everyone. Elevance Health delivered strong second quarter results, driven by solid execution and progress toward our strategy of becoming a lifetime trusted health partner, focused on the whole health needs of the consumers we serve. Second quarter GAAP earnings per share was $7.79, and adjusted earnings per share was $9.04, reflecting double-digit growth year-over-year. We are increasing our adjusted earnings per share outlook for the year to be greater than $32.85. Our health benefits business delivered particularly strong results as we continue to optimize our products, pricing, and operations. We are successfully executing against the planned margin recovery of our commercial risk and Medicare Advantage businesses back toward pre-pandemic levels, and we are pleased with the performance of our Medicaid business. Carelon continued to advance its strategy of integrating physical, behavioral, social, and pharmacy services to deliver whole health affordably with ongoing investments and capabilities focused on serving people across their entire healthcare journey. Carelon Services delivered solid organic growth, led by the expansion of post-acute care management solutions with our Medicare health plans, while Carelon Behavioral Health extended its leadership position through multiple external business wins with new and existing customers. CarelonRx also continued to grow nicely while investing in key value drivers, specifically specialty pharmacy and advanced home delivery. Expanding and more deeply integrating value-based care across the care continuum is foundational to our enterprise strategy. We are making significant progress in many key areas, including maternal health, where we have continued to expand our obstetrics practice consultants and quality incentive programs to additional markets, given outstanding early results. We are also working with care provider partners to enable acute care in the home, a patient-centered care alternative to traditional care in the hospital that improves cost, quality, and patient experiences. Connectivity with care provider partners is crucial to supporting our value-based care strategy and to enabling personalized, hybrid, and virtual care. Automation remains an area of focus and opportunity across Elevance Health, and deep datasets like ours are foundational for generative artificial intelligence. We are harnessing our adaptive artificial intelligence solution to promote identification and access to whole health services during physical health procedures like surgery. Our digital chronic concierge care program is a cloud-based care management platform that connects the patient's entire care management team to triage, monitor, and engage with patients through convenient digital channels. Guided by our enterprise strategy, we are fueled by a passion for making a positive difference in the world. Accordingly, environmental, social, and governance frameworks are embedded in our enterprise strategy. Now speaking, John Gallina, Executive Vice President, Chief Financial Officer. Thank you for joining us today. We are pleased to report strong second quarter results, including GAAP earnings per share of $7.79 and adjusted earnings per share of $9.04. We saw double-digit growth in revenue, operating income, and adjusted earnings per share, driven by the focused execution of our strategy. We have increased our adjusted earnings per share guidance to be greater than $32.85 in 2023, reflecting strong growth consistent with our long-term targeted compound annual growth rate. We ended the second quarter with 48 million members, up 938,000 year-over-year. We are seeing encouraging early indications that Medicaid beneficiaries losing coverage or transitioning into ACA exchange plans. We continue to expect by the end of the initial redetermination cycle that 40% to 45% of net new beneficiaries on Medicaid as a result of the suspension of redeterminations during the public health emergency will stay on Medicaid. Second quarter operating revenue of $43.4 billion increased $4.9 billion, or approximately 12.7% year-over-year. The consolidated benefit expense ratio for the second quarter was 86.4%, a meaningful improvement year-over-year. Elevance Health's adjusted operating expense ratio was 11% in the second quarter, down 10 basis points year-over-year. Operating gain for the enterprise grew 12% year-over-year in the second quarter. Operating margin for health benefits business expanded by 50 basis points year over year. Carelon delivered a strong quarter as well, with healthy top-line growth for CarelonRx and Carelon Services. We ended the second quarter with a debt-to-capital ratio of 39.6%, in line with our expectations and consistent with our target range. During the quarter, we repurchased 1.4 million shares of our common stock at a weighted average share price of $457.34 for approximately $646 million. We are reiterating our initial outlook for a full-year consolidated benefit expense ratio. Given the strong start to the year, the diversity of our assets, and the balance and resilience of our enterprise, we have raised our full-year outlook for adjusted earnings per share to greater than $32.85, reflecting growth that is consistent with our long-term target compound annual growth rate. We are pleased to report strong second quarter results, including GAAP earnings per share of $7.79 and adjusted earnings per share of $9.04, driving double-digit growth in revenue, operating income, and adjusted earnings per share. We have increased our adjusted earnings per share guidance to be greater than $32.85 in 2023, reflecting strong growth consistent with our long-term targeted compound annual growth rate. We ended the second quarter with 48 million members, up 938,000 year over year, and are seeing encouraging early indications that Medicaid beneficiaries losing coverage or transitioning into ACA exchange plans. The consolidated benefit expense ratio for the second quarter was 86.4%, a meaningful improvement year over year, while Elevance Health's adjusted operating expense ratio was 11% in the second quarter, down 10 basis points year over year. Operating gain for the enterprise grew 12% year over year in the second quarter, and operating margin for health benefits business expanded by 50 basis points year over year. We ended the second quarter with a debt-to-capital ratio of 39.6%, in line with our expectations and consistent with our target range. We repurchased 1.4 million shares of our common stock at a weighted average share price of $457.34 for approximately $646 million. We are reiterating our initial outlook for a full-year consolidated benefit expense ratio and have raised our full-year outlook for adjusted earnings per share to greater than $32.85, reflecting growth that is consistent with our long-term target compound annual growth rate. We remain focused on the execution of our strategy to become a lifetime trusted health partner by serving the whole health needs of the consumers we are privileged to serve. Credit Suisse analyst A.J. Rice inquired, "What trends have you seen in Medicare Advantage, commercial, and Medicaid that deviate from your expectations? How did you factor in utilization when submitting MA bids?" John Gallina replied, "Thank you, A.J., for the question. We are pleased with our second quarter results, which follow strong performance in the first quarter. The confusion around trends is due to the fact that the overall cost of healthcare has increased due to COVID-19, and we have already accounted for this in our pricing, projections, and guidance. Our first and second quarter results are in line with our expectations. We have raised our guidance by 15 cents to $32.85 per share and reaffirmed our 2023 benefit expense ratio." AllianceBernstein analyst Lance Wilkes inquired, "Could you discuss the wins Carelon has achieved, including self-insured employers and Blues, and how the build-out of pharmacy capabilities and advanced home delivery will affect upcoming PBM recontracting?" Peter Haytayan replied, "Thanks, Gail and Lance. Our strategy is to focus on managing high-cost, high-trend areas and capitating risk through Elevance Health. We're seeing this play out internally with P&L and initiatives such as post-acute care, durable medical equipment, and insourcing of genetic testing and oncology services. This success is translating externally, particularly with the Blues. Our home solutions, post-acute care offering, and payment integrity innovations are driving a lot of interest in our pipeline. Additionally, we're launching CarelonRx Pharmacy, which will be connected to our consumer engagement platform Sydney. It will offer quick scheduling of medications, access to pharmacists 24/7, and an Uber-like experience to track delivery. We're excited to launch this in 2024. Gail Boudreau replied, "Thanks, Lance. We're seeing a lot of success in our behavioral health and crisis management areas, as well as in our whole health strategy. Our government business is doing well, and we're seeing increased integration of physical and behavioral health in the commercial side. On the pharmacy side, we're leveraging strategic levers to maximize value." Wolfe Research analyst Justin Lake inquired, "Can you provide us with an update on the margins for Medicare, commercial, and Medicaid? Specifically, how are they running versus expectations, and what can you tell us about any volatility in Medicaid?" John Gallina replied, "Thank you for the question, Justin. We raised our EPS guidance and reaffirmed MLR guidance for the year, which indicates a positive trend. We expect healthcare costs to be higher than the baseline, and we've priced and factored this into our expectations. We've raised guidance twice this year and margins have improved 50 basis points year over year, on track to hit the 30 to 60 basis point improvement guidance. We took a charge due to a court ruling we disagree with, but without that charge, the margin improvement would have been higher. Commercial repricing is going well, Medicaid is in line with expectations, and Medicare Advantage is relatively in line aside from one geography. We're pleased with our performance and bullish on our expectations for the rest of the year. Gail Boudreau replied, "Thanks, Justin, for the question. We remain confident in our guidance on MLR and margins. We have been consistent all year and have not changed our view." Morgan Stanley analyst Michael Ha inquired, "What are your expectations for acuity mix shift, enrollment, and rate renewals in Medicaid redetermination?" Felicia Norwood replied, "Good morning, Michael. We've spent a lot of time ensuring that those eligible for Medicaid maintain their eligibility through redeterminations. It's still early, so we can't draw conclusions yet, but what we've seen is consistent with our expectations. CMS gave states guidelines to complete the process over 14 months, but states have taken their own approach, some front-loading or accelerating the process. We expect many members to return to Medicaid once we reach out and they provide the necessary documentation. We're also working with community-based organizations, care providers, and federally qualified health centers to advocate for our members. We have visibility into most of our rates for 2023 and 2024, and they are in line with our expectations. We're also taking acuity into account when setting rates and collaborating with states to ensure those truly eligible for Medicaid have access to coverage." Gail Boudreau replied, "Yes, Michael. As Felicia mentioned, our team has worked hard to ensure that our performance is in line with our expectations. We are pleased with the results. Thank you for your inquiry." Nephron research analyst Josh Raskin inquired, "Could you explain the higher medical cost trends and what specific line items are affected?" Peter Haytayan replied, "Thanks for the question, Joshua. We're pleased with Carelon's operating performance this year, and we remain confident in achieving our 25 to 50 basis points margin improvement guidance. Seasonality continues to evolve, and we're driving more business through government channels. In terms of pharmacy, we're still comfortable with our 6 to 6.5% margin guidance, despite a one-time favorable impact last year that we're not seeing this year." Deutsche Bank analyst George Hill inquired, "Can you provide an update on how the proposed changes to the CMS risk model will affect your benefit design and bid process for 2024? Felicia Norwood replied, "Good morning, George. Felicia Norwood here. We feel confident in our bids for 2024, taking into consideration the risk model changes and the importance of providing seniors with critical benefits. We've been thoughtful in our approach, balancing our aspirations for growth with respect to margins. We believe we've landed in a place that will offer attractive plans for our seniors and sustainable economics for us in the long term." JP Morgan Chase & Company analyst Lisa Gill inquired, "Can you provide some insight into the pent-up demand due to COVID and how GLP-1 utilization may affect medical cost trend in your pharmacy business?" John Gallina replied, "Thanks for the question, Lisa. Overall, we're seeing a higher cost structure due to COVID still being present, but not having the same significant impact it had in the past few years. We don't believe there is much pent-up demand or deferred care, though there may be small pockets of that. As far as GLP-1 drugs, they are just one element of our overall trend conversation. We expect trend to remain consistent with our expectations and don't anticipate any major changes due to CarelonRx." Bank of America Merrill Lynch analyst Kevin Fishbeck inquired, "Can you explain how you're expecting to keep 40 to 45% of Medicaid redeterminations, given that total employment is up 3 million since 2019? What are you seeing in terms of the other 55% and any delays in re-enrollment?" John Gallina replied, "Thanks, Kevin. We anticipate that 40 to 45% of our Medicaid population will remain on the program after the redetermination process is complete. We have conducted independent studies and feel confident in this projection. Additionally, we have seen that many non-blue states began their redeterminations earlier in the second quarter of 2023. We expect that 20 to 25% of those individuals will end up on employer-sponsored plans and 20 to 25% will end up on an individual ACA product. Our insights into the states beginning redeterminations in June are promising and validate our thought process." Gail Boudreau replied, "Thanks. We're seeing positive signs in the individual exchange, particularly in our blue states. Applications are up significantly compared to prior redeterminations. We're working hard with our state partners to ensure everyone understands their options, and we're having great success contacting individuals where we have the information. These are encouraging early signs. We'll continue to update as we get through this process." Stevens Incorporated analyst Scott Fidel inquired, "Could you please provide an update on the expected EPS split for 3Q and 4Q? Additionally, how are you thinking about medical costs in 2024 given the hardening pricing trends in the commercial premium market?" John Gallina replied, "Thanks for the question. We raised our EPS guidance to $32.85 or higher, which implies that more than 56% of our earnings will have occurred in the first half of the year. The current consensus estimates for the third quarter are consistent with our typical seasonality and will provide more insights on 2024 at the end of the year. Gail Boudreau replied, "Thanks for the question. We've maintained a consistent approach to pricing and we're staying disciplined with our forward view. We don't anticipate any changes, but we remain committed to our projection and pricing strategy." Barclays analyst Steve Valiquette inquired, "Could you please explain the factors that could contribute to Elevance's commercial membership growth acceleration in 24? Morgan Kendrick replied, "Thanks for the question, Steve. Our expectations for membership growth are in line with what we projected. This year, we saw receipts coming in slower and decisions being made longer, which is consistent with an economic shift. In our local market, we're just now getting into 4Q and 3Q, 4Q, and 1-to-1 all look promising. We've had strong retention this year and our win share continues at the rate we've seen. We're also seeing strong growth internally with employers consolidating their benefit partners from multiple vendors to one. Our pricing activities continue with our forward view of trend, so we're optimistic." Gail Boudreau replied, "Thanks, Morgan. Consolidation has been accelerating in recent years, with single source becoming the norm for both medical coverage and Carelon services. This is a positive trend for our whole health strategy." Goldman Sachs analyst Nate Rich inquired, "Could you please elaborate on the CarelonRx margins and the impact of BioPlus? Do you expect margins to remain flat for the full year? How has the pricing of biosimilar Humira come in relative to expectations? Is that a significant factor in the outlook for that segment?" Peter Haytan replied, "Thanks for the question, Nathan. We're confident in our pharmacy business, excluding BioPlus, and expect to come in at the 6 to 6.5% range. We're excited about biosimilars coming into the marketplace and driving cost and affordability down. We have historically supported biosimilars alongside our reference brand and expect to include a biosimilar or biosimilars in a similar formulary position as Humira this year. With the addition of BioPlus, we're now in a better position to manage specialty pharmacy holistically." Gail Boudreau replied, "Thank you, Pete. We're pleased with our performance year to date and confident that our strategy positions us well for the remainder of 2023 and beyond. Our focus on whole health and diverse suite of products and solutions will continue to meet the needs of clients, consumers, and communities we serve, advancing our strategy of becoming a lifetime trusted health partner. Thank you for your interest in Elevance Health. Have a great rest of the week."